Beautiful. I think it's a beautiful day. 38 degrees out there. This March 3rd day already. It's hard to believe that February is over. It feels like tax season just started. But here we are getting ready for the March 15th countdown. The program is Gilbert Talks Taxes. My name is Gilbert Carmona. I am an enrolled agent. An enrolled agent is a person licensed, enrolled with the Internal Revenue Service, the Department of the Treasury, to represent taxpayers in all matters. I do tax returns, tax preparation. I do complicated tax matters. I also can help you with state tax issues that you may have. I'm also a financial advisor. I have several licenses that qualify me to talk on this subject that we know as taxation. The program is Gilbert Talks Taxes. You're on WCAB 590 AM. Those of you live streaming, watching us, Todd got the audio fixed. We had some technical issues last week. You could see me, but you couldn't hear me. But we got that resolved this morning at www.wcab59.com, and it looks great. It looks great. It's a great picture. Yes, it does. Those of you live streaming us, Northland Cable Channel 5 subscribers, quite a few of you out there on Northland Cable Channel 5. Thank you very much for listening. My people out in Polk County, that's how they get me. Now, I have an office here in Rutherfordton, 113 Whitesides Road. I have an office in Tryon, Polk County, 226 South Trade Street, the beautiful Art Deco building right off the historic downtown, right on Trade Street. My telephone number is 828-289-9300. You can send me an email, gilbert@gilbertcarmona.com. And I've had a lot of phone calls this week from those of you listening. Thank you very much. I really have enjoyed every one of those phone calls. And my engineer this morning, Todd, good morning. I really think that they sit at home thinking of questions to call me with, because some of these questions, I'm like, wait, you got what? Takes me a minute. But it's Stump Gilbert. Let's call him and stump him. So tax season's underway, obviously. The people's refunds started coming in last week. Now, there were some that started coming in the week before. The IRS said if you have, and actually this was a law that 2 years ago got put on the books. We didn't know if they were going to carry it forward or just let it kind of fall by the wayside, but they liked it. They're doing it. If you have earned income tax credit, EITC, or EIC as some call it, EITC, earned income tax credit, or child tax credit on your tax return, your refund will be held. Your entire, actually not just your refund, there was a lot of confusion about this. Your entire tax return was shelved until February 15th. And they were going to review it. The idea is that it would slow down ID theft, because the way ID theft works, you got to get back to the whole premise of ID theft. The way it works is, and it's really organized crime that's now moved into ID theft. It used to just be people at home with their little computers that would get names, social security numbers, date of births, and make up tax returns and e-file them. And the idea was the first one in is the first one the computer from the IRS posts. So if so you file your tax return, you're the first one in for that social security number, that date of birth, that name number match, we call it. You're the first one in. If another one comes in behind it, that second one gets rejected. So the idea was to get them filed right away. Be the first one in there. So these they call them, they say hackers, scammers, whatever. Just this group of people was doing this. The object was to make up W-2s, claim dependents, get tax credits, get a refund. They would have it deposited to those debit cards, cash cards. They would have the money deposited. They're pretty untraceable. Or like the one man, and that actually happened right here in, I believe it was Polk County. A man had tax returns mailed to addresses in a neighborhood where he knew the people were vacationers. They were they were seasonal residents. They only came here during the summer. They were down in Florida, most of them, during the winter, so nobody was home, and he would make a tour of all their mailboxes in the morning looking for IRS checks, and he would use those addresses and then cash those checks somewhere. So that's what these people are doing. That's the premise behind it. That's the big scam, is to get as many of these in, have as many of them accepted, and get as many refunds as possible. And we saw in the last 7, 8, maybe 10 years, we've seen organized crime get into this, meaning people with the capability to file tens of thousands of tax returns. That's a lot of computing power there. There's a lot of names and numbers. So what the IRS noticed, is that these tax returns are getting in right away. So what they decided to do was to hold them all till the 15th of February. That way, if you did your tax return and it got rejected because somebody had already used your social or the social of a dependent. See, when I file that tax return, I'm an ERO. That's an electronic return originator. When I file your tax return, it goes from my computer to a server, of a third-party server that I pay for the service, and they send it right to the IRS. So that's the only middleman in this chain. As an ERO, it goes right there. Other people have to go through a series of third-party people. But as an ERO, it goes right away. I get the reject from the IRS right away. I've gotten the reject within literally minutes. It'll come back, there's a problem. Sometimes the reject is just the name, a typo or a transposed number, something like that. But a couple of years ago, we had a lot of rejects when the ID theft was really big. Most of it was socials, date of births were stolen from employers. You've heard me talk about this. I've warned employers, guard your data because you are a prime source of data. One company, a phony email from the president or the vice president got sent to an human resources director asking her for a complete list of every employee with address, social security number, and date of birth, and the dependents that they had on their health benefits with social security number, address, and date of birth. And really the question that everybody had, did it not seem strange to you that the president or CEO of this gigantic company would want the names and addresses and dates of births and social security numbers of all these employees? I mean, he has nothing to do with that. And she said, well, the email came from him. Turned out to be his email had been compromised, and she gave this man, or she gave whoever asked for it, thousands of names, addresses, social security numbers, dates of births. Several of them were clients of mine. Several of the employees were clients of mine. They came, we did those tax returns, they came back rejected. So what do we do in that case? What do you do if your ID has been compromised? You got to be proactive and get on it right away. You need to file a police report right away. It is theft. It's, it's my ID. Yes, it's theft. Somebody stole this from you. They are now getting ready to cause you problems that could potentially last forever. I have had somebody and we try it just to try it. We file that tax return every year. This is about the 4th year or 5th year we're going on doing this. We file that tax return and it comes back rejected every time. One of the dependents, and it's sad because she's a young girl, one of the dependents, her ID got stolen. The mother thinks somebody stole her social security card, but the social security card doesn't have the date of birth on it, so we don't know. We're just guessing. It comes back. So what do? You have to paper file. Well, the first thing you do is you file a police report if you live in the county, with the sheriff. They already know. They've done a bunch of them. They show up, they do the paperwork, they give you a copy of it. They'll ask you all the questions. Where do you think it happened? Do you know how it happened? Believe it or not, I had one where it was a family member, because you can actually sell this information online. Of course, you can do everything online, Todd. You can sell this information online, and it was a family member that had stolen for money. It's sad story, but She came back to me and told me later that they found out that's what happened. But they found out because they filed a police report. Several other family members had the same problem. All of a sudden, they put two and two together, realized we have a problem here. So that's why it's important you do that. Plus, the IRS also requires it, and your credit bureau will also require it if this gets to the point where you want to report it to your credit bureau. So you file a police report, you've had identity theft, you then do the form with the IRS. There's a form you do, you attach with it, and you paper file your tax return. Now they have a PIN, P-I-N, personal ID number. They have a PIN that they will send you every year going forward. And just realize that you cannot file you cannot electronically file your tax return without that PIN. You know, the bad side is you got to wait for this PIN and make sure you get it every year. And some people, it hasn't come. We've had to call the IRS to get it, or have them mail it, because they mail it. They won't give it to you over the phone. Have them mail it. So there is a little downside to that. The good side is anybody that goes to use your social, it will get rejected because they don't have the PIN. Okay, and double check with the IRS and make sure that they're sending the PIN to the right address. Because the thing I've wondered is, okay, what's to stop the hackers, the scammers, from creating a PIN and getting a PIN? So it just goes on. Remember, I said this 4 years ago. It was on the last program of my first year. I said the biggest challenge that the IRS is going to face, it's not all this stuff to do with taxes or collecting money or how to implement the tax code. That's day-to-day stuff for them. The biggest challenge is going to be ID theft. So getting back to what's happening this year, the law says that they have to hold all these tax returns that have earned income tax credit or child tax credit till the 15th. Now, people thought, and part of that may have been the preparer community didn't do a good job of letting everybody know. Maybe we just didn't get advertised well enough, but people thought that on the 15th they were going to get their money. No, it just meant that on the 15th they were going to start reviewing those tax returns and seeing if any paper returns saying identity theft had been filed. They were going to do a match on that, and they were going to review them all and make sure that, at least to the level that they could, make sure that these dependents were the right dependents for those tax returns. Then they were going to process them. So it was going to be 14 to 21 days from then, from the 15th of February. So now some people did get theirs early. Some refunds started coming around the 22nd, 21st, 22nd, 23rd. And usually that's just a small test lot that they release. But it created a big ripple. My phone started to ring off the wall because my next door neighbor got her refund. Where's mine? I don't know. I don't know what to tell you. Yeah, my next door neighbor, my cousin's next door neighbor's mailman said he got his refund. So it was, and I was getting those phone calls, and the IRS was getting flooded with phone calls. They actually sent out emails to us in the preparer community and said, tell your people to stop calling us. We can't tell them anything. The IRS will not tell you anything for at least 4 weeks. I mean, they can tell you if there's a problem, maybe. A lot of times they don't know what the problem is or that there's a problem. It's just being held for review, or it's still the computer says it's still processing. It's still under review. Doesn't mean there's a problem. And of course, the where's my refund tool was wrong half the time. People were calling me up saying the tool doesn't have any information. Well, that's usually the case the first couple of weeks of tax season. I don't know why, but it just is. So the tool wasn't accurate. But you got to wait at least 21 days. If you haven't gotten your refund yet, wait until at least the end of this week before you start calling around, because you're really not going to get any information other than it's still under review. If you get a letter, the letter will show up between the third and fourth week. If there's a problem, you'll get a letter telling you what the problem is. So this is the week that the refunds are supposed to be coming out, according to the plan. So I expect the bulk of them to hit this week. Typically, they come out on Tuesday, Wednesday, Thursday. Very few come out on Monday or Friday. Actually, none. I've never seen any come out on Friday. But Tuesday, Wednesday, Thursday, they'll be coming out. So if you haven't gotten yours yet, just wait. If you've had ID theft, you know what to do. If you've already had it, you're going to just have to sit and wait. Let's take our first break, and we're going to come back. I've got quite a few things I want to talk about. What to do if you haven't gotten your W-2 yet. What to do if you got a 1099, but you were expecting a W-2. Believe it or not, that's a problem. This is Gilbert Talks Taxes, WCAB 590 AM.
I want to welcome Tim Schlabach and Foothills Photo Works, a professional hybrid commercial photography studio. If you're concerned about your social media image, listen up. Whether you're an executive, real estate broker, lawyer, or business owner, your image matters now more than ever. And you know first impressions count. Whether you need professional portraits, corporate headshots, images of your products or facility, aerial photography, and videos of buildings, boats, or large acreage, affordable professional help is here for you. Foothills Photo Works can create media that will help your prospects get to know you better and help you look your best. Call for an appointment. That number is 828-668-2304. Mention this ad and receive 15% off your first session. That's 828-668-2304. Foothills Photo Works, your media professionals.
It's official. I'm celebrating another year of looking fabulous, all because of RSL Salon. Whether it's a hairstyle, a manicure, or a pedicure, call Robin at 289-9110 because everyone deserves to look fabulous. That's 289-9110. We are back. We are back. Everyone does deserve to look fabulous. And Robin does have me looking fabulous. Those of you seeing me live, you can see how fabulous I look. WCAB. It's www.wcab59.com. Northland Cable, Channel 5 subscribers. Good morning. This is Gilbert Talks Taxes. Again, my telephone number is 828-289-9300. Now, you can call the studio here live. And last week, were they calling? Todd, it was at the end of the program, it was a flurry of questions that people had. And those of you that have called me this week with questions, thank you so much. You can send me an email, gilbert@gilbertcarmona.com. Mostly, this time of the year, we're focusing on tax returns. That's what we're trying to get done. Now, before I get into this, dates that are coming up. Dates, March 15th. Okay, just 2 weeks away, less than 2 weeks away, 12 days away. March 15th, partnership tax returns and 1120S, S as in Sam, tax returns are due. So if you file an 1120S or a partnership tax return, they are due on the 15th. Okay, now right now, if you don't have it all together and you don't think you're going to get it together, my advice to you is file an extension. Just go ahead and get it out of the way. File that extension now so you're not doing it at the last minute, because if you don't think you're going to get it together by now, you probably won't. So just file that extension. That pushes it back to September to get it wrapped up. And a lot of times, it's not people's faults they have to file an extension, just the paperwork is slow in coming in. I still am hearing people have not gotten 1099s. People have not gotten, the K-1, technically, the tax return's not due till the 15th of March, so the K-1 won't even go out till that tax return's done. And people need that K-1 to do their personal return. So I've had people say, well, I'm waiting on this K-1. Well, it doesn't have to be done till March 15th. But brokerage statements, notorious for coming out late. So this is the time of the year that people show up. They haven't gotten their W-2 yet. Speaking of late, they haven't gotten their W-2 yet. Now, I always have people that are calling me January 31st saying, I haven't got my W-2 yet, but I want to file my tax return. By law, as an electronic return originator, I cannot file your tax return electronically without a W-2. I cannot use a pay stub. Why? Well, most of the time when you use a pay stub, it's going to be wrong. That's number one. Number two, it's just the law. I'm not supposed to. So you are supposed to get it from your employer, or try to get it from your employer. Now, your employer is supposed to have it in the mail by January 31st. It's not that if you don't get it by that day or even by February 1st, you can go and file or you can call the IRS and report your employer. It doesn't work that way. Your employer may legitimately have reasons for running late. I mean, things happen. Computer systems, accounting problems, any number of things, and the IRS understands this. And it's just the real world. It happens. So you're supposed to wait. If you call the IRS, they'll tell you to call them back after February. They won't do anything before February, the end of February. So if you haven't received your W-2 by the end of February, the IRS will tell you again, contact your employer, ask them for your current, contact your current or former employer and try to get a copy of your W-2. Make sure your employer has the correct address. I've run into this. People say, well, I haven't gotten it. I moved, and they don't have my new address. Well, it is your responsibility as the employee or former employee to tell them your new address. It is not their responsibility. I actually had an employer call me this year and say that the employee was threatening to report him to the IRS or whatever because he didn't get his W-2 and he didn't have the employee's address. Were they liable? No, they're not. Their job, the only responsibility they have is to send that W-2 or 1099 to the last known address on file. So if you're an employer and you sent out W-2s and they come back from the post office with that little yellow sticker on it, the one that says unable to deliver, or it said return to sender, RTS, and a big circle around it, just stick that in that employee's file. That is all you're required to do, nothing else. It is the employee or former employee's job to tell you that they have a new address and or give you an address that they want you to mail this to. Okay, you have no liability otherwise because they're irresponsible. Doesn't fall back on you. So call your employer, make sure they've got your right address, and have them send you a copy. Some employers will be more than happy. They'll fax it to my office. They'll mail it to me. I've had them email it to me as long as it's from you and you say it's okay. So most employers will work with you. So you call them, let them know there's a problem, you haven't gotten it. Now, if you, for whatever reason, you know that you can't get it, or you've tried and the employer, they may be closed, they may be bankrupt, they're not there, you can't get them, whatever reason, you can call the IRS and you call their main number. That's the 800-829-1040, 1040 number, and tell them your situation. You need your name, address, social security number, telephone number. You need the employer's name, address, telephone number, the dates you work there, and an estimate, a reasonable estimate of your wages and federal income. Use your last pay stub to get that information. The IRS will try to communicate with that employer. It's not like a credit card company that they're going to go on their screen and pull up your W-2. It doesn't work that way. They're not going to give you that information. They will contact the employer and ask the employer to get that information to you. Okay, that's all they're going to do. So if you still haven't gotten it, now we're pushing towards the end of March. You're still responsible to file your tax return. Okay, it's still your job. There's a form you can fill out called a 4852. It's a substitute for W-2, in which case you estimate how much you should have gotten. You fill it out with that form. You cannot e-file with that form. You cannot go on Now, people do it all the time. They go on TurboTax and they go ahead and plug those numbers in like it was a W-2, and they go ahead and process their tax return. And you may never hear anything about it. You get your refund or you pay your money you owe and you move on. But I see the other side of it when they come to my office with letters from the IRS and wanting my help because the numbers they put in were wrong. And the IRS comes back and says, especially, this is the one, they put it in there and they get a refund, and the IRS sends them a letter because it'll come 4 or 5 months later. They'll send you a letter that you owe all that money back because you were wrong. I'm telling you, you cannot. Pay stubs are risky things to use. The information on them is not always current. It has not been reconciled to other things going on while you work there, like employee benefits that might be taxable or employee deductions. There's all kinds of things that happen on a W-2. It's not just a form that loosely gets filled out. Okay? So be careful if you're going to do this. The right way to do it is to fill out that form, 4852, and you paper file that return, and you send it in, and then the IRS will process it, and you'll be in the system correctly that you've had this problem. Then they will research it and make sure you're going to getting the right refund or you're paying the right amount of tax, and they'll process it for you. Now, let's say the W-2 you got is wrong from the employer, and you get what's called a corrected W-2. A lot of times, most of the ones I see, it doesn't affect the tax return, but if you get a corrected W-2, don't ignore those. If you're one of my clients, bring it to me as soon as you get it, because you may have a tax problem. You may owe more money, or you may owe some of your refund back. Who knows? That could be anything. Most of the time, however, it's the benefits, it's that other stuff that your employer is responsible for reporting correctly to the IRS, but it really doesn't affect your return. It doesn't affect whether you owe or getting a refund. Now, something that happens, and it's happened, there was actually an employer that was doing that here in the county, and I don't know if he's still around or not. They didn't come with this problem this year, but last year. Employees are working, people are working for this man. At the end of the year, he gives them a 1099. At no point did they think they were going to get a 1099. What is a 1099? A 1099 miscellaneous, or a 1099M, M-I-S-C is what it says on there, is a form that you give to a vendor or a subcontractor showing the amount of money you paid him. It's to report to the IRS that you gave a person who was not an employee money, and you in turn are taking that expense on your tax return. That person is responsible for showing that on their tax return as income. Okay. The problem with that is there are no taxes withheld on that form. And when you get that form, it means you are self-employed. And as a self-employed person, you are responsible for self-employment tax. That is the Social Security, the Medicaid, and the matching, Medicare, and the matching Medicare. Okay, and the matching Social Security. So you are now looking at a 15% tax on that money, plus income tax on the profit. So you now have a tax problem. But the whole time you were working for that man, you thought you were an employee and you were going to get a W-2. And you thought he was withholding, and he may have been withholding. Now, in the case of this person that I had to help the employees with, he was not withholding tax. He was just giving them a flat out, handwritten check every week. They worked for him. They get this 1099. And I said to them, at no point did you wonder why you weren't getting a little check stub saying how much taxes was being withheld. They said, well, they never thought about it. It didn't occur to them. They were just working and getting paid, and they were happy to get paid. I said, well, you really should have known something was not right here. But there is a form that you can fill out, and it's a lengthy form that you can fill out, attach that to your tax return, paper file that tax return, and it puts that burden back on that employer. Now, the IRS will contact that employer, and he'll have some explaining to do on this. Okay? So if you got a 1099 miscellaneous and you thought you were supposed to get a W-2, you really need to go to somebody and you don't know what to do. Go to somebody that can help you with this, because your tax return just got complicated. Okay? But there is a way to do it, and then we fill out the tax return like it was a W-2. But on the form there, it will tell you what to do. Let's go ahead and take a break. I'm a little late here. Let's take another break. This is Gilbert Talks Taxes, WCAB 590 AM. This is Gilbert. If you owe the IRS past due taxes, don't call those toll-free national numbers. Local, affordable help is right here in Rutherford County. Stop garnishments, levies, and liens. Call Gilbert Carmona at 828-289-9300. All initial consultations are free. Call Gilbert, 828-289-9300. Good morning, everybody. We're back. That was just a quick break here so I could catch my breath here. We are having coffee and donuts this morning. Compliments of Jesse James Railroad Express. Actually, not compliments. I paid for it. But provided by. Yeah, compliments of him getting up and doing it and having the coffee ready for me this morning. Jesse does a great job over there. The coffee's always good. It's that Peabody. I just love that. So, okay, so we talked about that enough. Let's move on. Let us move on. What should we talk about next, Todd? I've got literally a stack of papers here of things to talk about. What should we talk about? I know. A big one that I get questions on this time of the year. Yeah, I've got the stack of papers. I don't even look at them. I just go right into it. A big one that I get. The scenario unfolds something like this. I'm doing the tax return, going over the things, and I said, last year you claimed these 3 dependents. Are they still your dependents this year? We got little Timmy, little Tommy, and little Susie. Well, little Susie is now Big Susie, and she got a job, so she's not my dependent anymore. She's doing her own tax return. Well, no, that doesn't mean she's not your dependent anymore. There are rules for, we do the tests, they're called tests, for is she still dependent. Just because she got a job doesn't mean she's not your dependent anymore. Well, she's going to file her own tax return. Great, she's going to file her own tax return. It's wonderful. But that still doesn't mean she's not your dependent. Is she your dependent? Well, yeah, she lives at the house. I support her. The residency test, the relationship test, all the tests are there. And I say, well, how much did she make at this job? Because, well, she's in college. She's maybe going to isothermal, or she may be going, to a local college that she's commuting to. She may be going to Gardner-Webb. She may be going to Limestone, a close college. She's still commuting. I mean, Lenore Rhine, she may be going 3 days a week. She's commuting. She still lives at the house. Or even if she's living on campus, she's still your dependent. That still counts. So I'm going through the test with them. Well, and how much did she make at this job? Well, she made $6,000. No, she's still your dependent. Technically, she doesn't even need to file a tax return because she's below threshold. So, but she's going to want to file a tax return because whatever little bit of money they withheld, she'll get back, still as your dependent. But there's this thing that people think, well, because she got a job, I can no longer claim her. No. As long as you're providing more than half her support, and unless she's like extremely frugal, I don't know anybody that's supporting themselves on $6,000 a year or $9,000 a year and going to college, and which you're paying for. So and even if she's got grants, like at isothermal, she could have a Pell Grant, and she's doing that, she's still your dependent. The thing, though, the mistake I see people make is don't let Susie just run out and do her tax return. It'd be good if the same person, I tell people, please let me do their tax return also, not because I need more work, but because that way it's done correctly. That person needs to put on their tax return that they are the dependent of another. I was a dependent of another. what that does is it eliminates the exemption, because you, the parent, the person responsible, you get that exemption. When they're your dependent, you get their exemption. Each person is entitled to one exemption. That's it, one exemption. Whether it's on your tax return or on somebody else's tax return, you get one exemption. So they need to put that they're the dependent of another. And if they only made $6,000, $5,000, $4,000, $8,000, if they're going to be below that standard deduction for single, they're going to get their refund. They're going to get whatever money they got withheld, whether they're dependent of another or not, because they're below that threshold. So they're going to get that. They're going to get that refund. Now, let's say they made a little bit more, 10, 11,000. You're still supporting them. They're going to school. All their money goes to school. You're paying for their school, whatever the scenario is. I go through the questions with you. Even if them filing a tax return takes a little bit of their refund, you're still coming out ahead, because you're going to get a bigger refund, especially if you have child tax credit. I'm sorry, not child tax credit, earned income tax credit. Or it may benefit you to get that deduction, the exemption, because you're in a higher tax bracket. So it's going to benefit you. I mean, it may cost her, and I'm just making these numbers up. Okay, these are not rule of thumb numbers. It may cost her $100 or $200, but you're going to get way more than doing that. And she is legitimately your dependent, because this whole conversation is based on that. But just because she filed a tax return does not mean that you cannot claim her as a dependent. Now, the reason this is such a problem, and I'm even talking about it, is because little Susie, who goes to college and knows how to use a computer, ran out and did it on TurboTax so she can get that whopping $72 refund. I actually had a guy do it for a $15 refund. Totally messed his parents' tax return up and all our tax planning. He did his tax return to get $15. Because, of course, when you're 18, $15 is a lot of money. But I filed the parents' tax return. It comes back rejected because one of the dependents had already filed the tax return. At first, the first thing I thought is, oh no, ID theft. That was the first thing that went up. I called the parents right away, let them know. It got rejected. I said, did little Timmy, did he file a tax return? They said, no, he did have a job. And I said, he had a job? He worked? Yes. Can you give me his telephone number? So I called little Timmy, and sure enough, he had run out. He did work. He worked for like a month or something during the spring break or something there while he was at school, because he was a full-time student. During holiday break is what it was. He worked a little bit there, and he filed his tax return, did not put on there that he was the dependent of another, got his $15. So what do you do in this case? I have to amend little Timmy's tax return saying he was dependent of another. We got to get that in the system. And now we have to paper file the parents' tax return. And of course I attach a copy of of little Timmy's amended tax return with it to let them know. And it held their refund up, which wasn't the issue. It held just the whole tax return up, processing of it about 12 weeks, because they have to verify and everything. So it's a problem you want to avoid, because they didn't get their refund for probably 16 weeks, if I'm remembering right. 12 to 16 weeks, somewhere in there. They shot me an email and said, we got our refund. Because I said, let me know. I want to make sure you got it, and I want to make sure you get the right amount. Everything's done right. And they shot me an email saying we got it. So I want to say, yeah, 12 to 16 weeks, somewhere in there. So it can complicate things. So don't assume just because your dependent has a job and is going to file a tax return, they're no longer your dependent. They're your dependent if you support them and they're in college till they're 23 years old. 18 to 23, you qualify for earned income tax credit. You can take the college, the American Opportunity Tax Credit if you're helping them pay for their school, if that's yours, with that 1098T. There's a lot of benefits to doing this. Don't throw this all away. There's a lot to review there. There's a lot to talk about there. I'm gonna let's switch gears here a little bit. I got a few minutes till the break. Again, if you have any questions, please call me 828-289-9300. Send me an email, Gilbert at gilbertcarmona.com. A couple of interesting things that came out. Now we're going to start talking about going forward with the new tax law, because there's a lot of tax planning here, folks. There's a lot to get a hold of. You know, the law was passed December 22nd when we were all involved with other things like getting ready for this tax season, doing end of the year tax planning with people, preparing W-2s and 1099s and reconciling people's financial statements. So we haven't had a lot of time, and then we come right into tax season. We had the first couple of weeks of January to really review some of this. There's a lot about this law we're still learning. Laws, really changes to the law, and we haven't figured it all out. So when you hear the media talk about how horrible this tax law is and this, that, the other thing, nobody really knows. Actually, there's nothing horrible about it. Everything we're seeing, it's great. There's some things that are changing. There are some things that on the face of it you look and you go, well, that's going to be different. Like the entertainment expenses that are no longer allowed, memberships and things that are no longer allowed. But there's a silver lining to all of this, and that is a lower tax rate. Lower tax rates, doubled the standard deduction. I mean, I can go on. There's a lot of things. Most of you people have seen the lower tax rate. You're seeing your checks are a little bit bigger every week, and you're seeing my software tells me next year, all things being equal, just about everybody is getting a bigger refund next year. Some, it's substantial. $2,200, $2,300, $2,800. Most are in the $1,200 to $1,600 price point. Some are as low as $400 or $500. But yeah, questions. People are calling here. Oh, somebody wants my number again. I'll be more than happy to do that. My telephone number is 828-289-9300. Thank you very much. That's 828-289-9300. I've actually gotten that before. People say, you don't give your telephone number out enough. That is, I know. I like this so much, I go right into it, and 1 hour just flies by. And I don't say half the things I want to say. So going forward with this new tax law, there was some misconception about home equity loans and them being still deductible under the new law. I don't know what media outlet put that out there, but it got put out there that home equity loans, they call them HELOCs, home equity lines of credit, would not be tax deductible. The IRS responding, and I'm reading here, this is actually from the IRS, IR 2018-32, Todd, for those of you out there in the preparer community that are listening. And there's a lot of them that listen to me, because the people tell me, my tax preparer said that you said, and they call me to verify. Responding to many questions received from taxpayers and tax professionals, the IRS said that despite newly enacted restrictions on home mortgages, taxpayers can still deduct interest on a home equity loan, home equity line of credit, or second mortgage, regardless of how the loan is labeled. And this is again an example of where the media jumped on a story without actually consulting somebody in the preparer community that's actually reading this law, and said, well, if it's labeled this way or that way, you can't deduct it. Well, that was not true. So under the new law, interest on home equity loan used to build in addition to an existing home is typically deductible. So just like a first mortgage, okay, you get a loan, a line of credit, whether you use it to pay off credit card debt or just for living, you can deduct it just like you do your first one. You can deduct the interest on it. You can deduct it on a HELOC or a line of credit. It's that simple. I don't want to get into all the details. It got put out there that no, this wasn't. I don't know why, but yes, it is. It's deductible. Let's take our last break, and I am going to come back, and I'm going to talk a little bit about Obamacare, and I'm going to talk about, I know, Todd, it has not gone away. It's still out there, and I'm going to talk about the estate gift and the estate and gift tax exemptions. They've really increased. This is great news. Right here, Gilbert Talks Taxes, WCAB 590 AM.
My closet keeps shrinking my clothes. And if you have that problem, take them to Nancy at Nancy's Alteration Shop at 610 South Broadway, Forest City. Call Nancy today at 429-6900. Wear the clothes you like to wear. Let Nancy bring them back to life for you. That's Nancy's Alteration Shop, 610 South Broadway, Forest City.
I want to tell you about a little-known Rutherford County gem, Integrity Marble and Granite, located at 287 Shiloh Road in Forest City. They are the premier stone fabrication company in the western North Carolina region. They specialize in granite, marble, and natural stone, offering complete design and installation. Their design center and Kohler showroom features vanities, decorative accessories, bathroom, and kitchen fixtures. You do not have to go to Charlotte or Asheville for this kind of quality. We have it right here in Forest City. Stop in their showroom and browse their beautiful displays, or you can call 828-247-8801 for a free quote. You can also go to their website, www.integritymarblegranite.com, and look at the pictures and see samples of their available materials. Now, mention you heard it on Gilbert Talks Taxes, and they will give you $100 off any sink purchase. That's Integrity Marble and Granite. Welcome back. This is Gilbert Talks Taxes, WCAB 590 AM. This March 3rd day. Temperature's just skyrocketing there, Todd. It's 43.8 degrees outside. It's promising to be a beautiful day today. Okay, so I'm going to talk about, again, I'm going to give my telephone number out again. 828-289-9300. I have an office here in Rutherfordton, 113 Whitesides Road, right next to Southern Baptist Church. Little white house there. Got a sign in front, and I have another office in Tryon, Polk County. The beautiful Art Deco building, 226 South Trade Street, off the historic Tryon downtown. The tax bill, now, I'm going to talk about estate gift tax, inheritance tax. And a lot of people say, oh, this will not affect me because these, the old, there's no inheritance tax. Let me start this way. There's no inheritance tax. There's no inheritance tax at the state level, okay? Inheritance tax at the federal level. Now, inheritance tax is a generic term. It's actually an estate tax on estates before the, and the tax is supposed, the estate pays the tax before the beneficiaries get the money. Now, the beneficiaries do not pay tax on inheritance unless what they inherit is a taxable asset, like an IRA. An inherited IRA has its own set of rules because that money was put away in the IRA. And when I say IRA, I'm talking about typically a Roth has already been pre-taxed, but a traditional or a 401k that might have been rolled over, 403b, or any of these retirement plans that have a beneficiary provision and the beneficiary gets that money. Well, that money was put away tax-free, not exempt, because you're going to pay the tax at some point down the line. We're just kicking the can up the road as to when you pay the tax. The theory behind a traditional IRA, which is an individual retirement account, the theory behind it is that you put the money away tax-free today, and you will pay the tax on it when you withdraw the money from your account in retirement when you are in a lower tax bracket. That's the theory, and it's a good theory. It works. A couple of problems with that, and that's not really what I want to talk about now, but a couple of the problems with that is adults are working longer, they are living longer, they are working longer. Traditionally, most people would go into retirement mid-60s and start living off that money. So the required minimum distribution, that is, you have to start pulling money out at 70 and a half. So these are just all considerations when you set these accounts up, okay? So, and another thing that's happening is with adults working longer, you've got people that are actually second career people, we call them, actually retiring with 2 pensions and Social Security. So they're not necessarily in a lower tax bracket at retirement. They're actually in a pretty high tax bracket. So there's some holes to that theory, but it works. It's worked out well. So the idea is there's a beneficiary. The beneficiary gets that IRA. Well, now that beneficiary is liable for those taxes on that IRA. It is like it was their IRA. Their rules kick in. Okay, so other than that, though, there is no tax on inherited money. Now, another thing that can happen is if a portfolio transfers to the beneficiary is responsible for taxes on the gain of that money after the death of the person who had the portfolio. So you could have some tax there. But if you're inheriting a big enough portfolio that the interest and dividends are, you have to pay tax on it, I don't think you got a problem. You've got money. You've got money to pay that little bit of tax, just pay it. But okay, so inheritances are not taxable up to $5.4 million. Well, the new tax law, I got this here hot off the press. The new tax law, and this is the federal estate gift and generation skipping transfer. Generation skipping transfers is a tax strategy that we apply. Sometimes you'll hear people talk about a stretch IRA or a stretch portfolio. It's a generation skipping transfer. You can actually skip the generation. It's a great way to pass wealth down. So it's increased with the new tax law to $11.2 million, $11,200,000 for individuals, and $22.4 million for married couples. Right now it's 5.49 actually for individual, or 10.98 for married for 2017. Now, when I start talking about these things, people say to me, I will never see that kind of money ever. Nobody in my family has that kind of money. Don't be so sure. I just had another one this week. Okay, you've heard me share, Todd. You've heard me talk about Uncle Marvin. Uncle Marvin is my generic rich relative. The story actually begins with a real Uncle Marvin. I'm gonna tell the story again. I had a man call me, said I need to file a tax return. I haven't filed a tax return in years because I've been on disability and I collect Social Security, and my wife doesn't work and she's just going to start collecting Social Security, so we have not filed a tax return. And my attorney told me I'm going to have to file a tax return, and I said, really, why do you have to file a tax return? And he said, I inherited some money. I said, really, you inherited some money? He goes, yes, I inherited, and I've actually had this same story has happened 3 times. So the one person inherited the first Uncle Marvin story, he inherited $550,000, and there was more coming. That's how much he had gotten that the attorney was able to release. And I said, really? He goes, and I didn't know I was going to get it. It just came out of nowhere. I said, really? Tell me about this. He said, Uncle Marvin died. I said, Uncle Marvin died? I said, how many beneficiaries were there? He said, there were 5 of us. And Uncle Marvin left us all. We each, so far, have gotten $550,000, and there's about another couple of $100,000 coming. There's about another $1 million that the attorney can't release yet. He goes, and none of us knew Uncle Marvin had any money. He said, I wish I would have known. I would have been nicer to him. Uncle Marvin was a single man that lived just north of here, never had any dependents, worked at a mill for 40 years, and never spent a dime. Lived in a nice little house, loved his family. Everybody knew him. Everybody had nothing but good to say about him. They loved him. Just kept to himself. Well, Uncle Marvin had bought savings bonds every week. He would buy a savings bond taken out of his paycheck. When they went through all the paperwork at his house, they found a stack of them about 3 inches thick, rubber banded together. Okay? He worked at the mill and maxed out his retirement plan, his pension plan, and put money in every little life insurance thing that came along. It took the attorney about 6 months to sort it all out and find out everything Uncle Marvin had. He had, I don't know how much land, and he had the house, all of it paid for, of course, a couple of cars. When you add all of that together, Uncle Marvin had $2.5 million. Now, the one Uncle Marvin had $1.8 million. I had another one that had $3 million. Now I have one, just this week, almost $5 million. Man was older man. His wife passed away maybe about 5 years before he died. The children didn't think his own children, didn't think he had any money. Poor dad is living on Social Security, is what they thought. Poor dad was sitting on a portfolio worth over $4 million, and nobody knew about it. So when people say, oh, this will never happen to me, folks, it could happen to anybody, because that whole generation was a different generation. They actually saved money. So don't think this will never happen. And I get back to, make sure, those of you that have older parents, make sure that all the beneficiaries on all their accounts are correct. Make sure you know what they have. Make sure you know their life insurance. I have a kit, K-I-T, a kit that I go over with people, and I can give them some documents. It's a little portfolio kit. It's got little tabs, and you sort all your paperwork, and it's got questions to ask. I just had another one 2 weeks ago. Father passed away. Fortunately, last year, we had gone through all the land he owned, and it was quite a bit. We went through all the deeds, went through all the life insurance, went through all the investments, transferred what needed to be transferred, made sure all the right names were on everything, and sure enough, in January, he passed away. Now, at the time, we didn't know he was going to pass away. He was actually in great health. It shocked everybody. It shocked everybody. People are still shocked. I was surprised when they told me he passed away. I said, wait, are you sure? Here I'm talking to his son, right? Are you sure he passed away? I mean, the last time I saw him, he was in great health. He was older, but he was in great health, and just, I'm going to miss him. He was a great guy. He used to come to the office and tell us great stories back in the day here in the county. And but we did all that in the fall, and are we glad we did? Because now you don't have this scenario where you're sorting out millions of dollars worth of stuff, because things appreciate. And they say, well, I bought that land for $10,000 30 years ago, 40 years ago. It was cost me $10,000. A piece of land they bought for $10,000 40 years ago is worth $200,000 today. And depending on where it is, it could be worth more. So don't think you're not going to have a tax problem. I can't drive this point home enough. I see it all the time. A tax problem, worse than that, you're going to have an inheritance problem. And you could get stuck with some inheritance bill. But the good news about this is, in raising this tax bill, it really makes for some tax planning that you need to do. Last, I got 2 minutes left, Todd. 2 minutes. Todd's holding up his 30 seconds. You're supposed to hold up your 1 minute finger. Oh, okay. No, that's late, Todd. Sorry. I wanted to talk about Obamacare. 20 states are suing the federal government. Remember, I said it. I went on record. Obamacare is going to be the biggest failure, and it is failing big. There is a lawsuit right now. 20 states are suing because, really, this should have happened 2 years ago. But it's going to be a story to watch. Well, I'm out of time. If you need me, call me, 828-289-9300. I am Gilbert Carmona.